and business tax side to do the right things that will help your business get the most amount of money. Look, there's a lot of things like simply showing a little bit of a loss or a little bit of a profit that mean a significant difference to you as a business owner. And that's exactly what we're going to talk about during today's training. Everything you need to know about accrual, cash accounting, all these different things about business taxes, personal taxes, how it affects your ability to get money. And by the time you leave this training, you're going to understand exactly what to know on the personal tax side and the business tax side to do the right way to be able to set yourself up for maximum funding. Simple things are the difference between you getting money for your business and not. And that's exactly what we're going to be diving into today. So taxes and business lending, right? If you're a business owner, you have to pay personal taxes, right? You pay business income taxes, and those returns have a greater impact than you may even know with your ability to be able to get money for your business. As a matter of fact, when we look at our 125 fundability factors, we've got 23 core principles within them, and business tax returns is definitely one of them, because what you do here is vital to getting the best kind of financing. I can't say that enough, so let me say it again. Okay, what you do here, especially with your business tax returns, is vital to getting the best and the right kind of financing. So if you want term loans, if you want SBA loans, you got to get this right. If you do your tax returns the right way, if you have the right amount of years of tax returns, it's the difference between you getting a 30-year loan or getting a 2-year loan, of you getting a 4% interest rate or getting a 30% interest rate. Literally, it is that important, which is why we're going to be diving into it, talking about it today. Now, if you're just coming in, tell me where you're from. Always love giving you a shout out. Terry is already ahead of the pack and said hello from Atlanta. Hello, Terry. Thanks for saying hi. Make sure you tell me where you're from. I always like giving you a shout out and saying hello. Okay, so according to the IRS, except for partnerships, all businesses have to file an income tax return. Okay, so you've got to make sure that you file your taxes every year. Look, one of the big problems you're going to run into if you want to get term loans and SBA loans, well, let's stop there and talk about funding for a minute. The best funding you're ever going to get has two very unique things. It's one, long-term. The longer term you can get, the better your payment's going to be. Matter of fact, whenever you're looking for any kind of funding that's not revolving, credit card or credit line, you're looking at an actual loan, you want to make sure you can get the longest loan term you can. It's the one thing that has the biggest impact on your payment. So if you want to have a low payment, you got to have a long term, okay? The second thing is interest, right? How much interest you pay? Do you pay 4 or do you pay 40%? Yes, there's 4% interest rates, and yes, there's 40% interest rates, right? So what you want to do is always get the longer term, the lower rate. And that comes from places like traditional banks that offer SBA financing, or what we call term loans, with longer term loans. You can only get these if you have filed business tax returns. Those options aren't even available if you're not filing tax returns. So you got to make sure you're filing tax returns every single year. If you run and hide from this, your ability to get the best kind of financing is inhibited, and basically you're not even going to be able to get it at all. Okay, so tax returns 101. They're not exactly the same as personal tax returns. Business, of course, one big difference is quarterly estimated tax. So sole proprietors and S corps that expect to owe tax of $1,000 or more when they file their business tax returns generally need to make estimated payments. Corporations that expect to owe $500 or more will need to pay estimated taxes as well. So there's a great accounting strategy that's out in the world that's known as Profit First. And if you haven't read the book Profit First, you should. Profit First is the difference between you having financial freedom in your business and not. And what I mean by that is that a lot of business owners constantly take their money and put all their money back in the business to grow it. And they don't have very much money for anything else. They don't have reserves. They don't have cash in the bank. They get into trouble when it comes to tax time. Say they put enough money set aside to file taxes or to pay for taxes. And then you've also got the business owners that come in and that actually do set money aside. And this is Profit First. Profit First teaches, first of all, figure out the profit that you want and set up an account for that profit to go into. The reason for this is something that we call Parkinson's Law. And Parkinson's Law basically says that the demand of something will expand to meet its supply. Let me give you a simple example. Sure, you can relate to this, right? Let's say you make more money. Let's say you make $1,000 more a month. Well, have you ever noticed before that when that happens, all of a sudden, all these unexpected costs and expenses come in that eat up a large part of the extra money you made, right? So you're like, I'm going to make an extra $1,000 a month. I'm going to use that to do A, B, C, D. And then it never happens because all of a sudden, all this stuff that wasn't there before now fills up that space. And now all of a sudden, the money you thought you had, you don't have. This happens with everything. It happens with our time as well, right? So we free up time by doing something, by hiring somebody to clean our house. But then all of a sudden, that time gets consumed because now we've got other chores like, projects to take on instead. So the demand of something is always going to expand to reach its supply. Okay. And so what happens in a normal spending of a business is that a business will spend all the money it has to spend unless you stop that, unless you start creating separate accounts to put money into. And this is what Profit First teaches is, hey, figure out the profit you want, set the money aside. If you don't do that, then the needs of the business will eat up all the cash and you'll never be profitable. You never have extra money in the business, which is what you want, right? So with Profit First, it's creating separate accounts. And one of those is a tax account where you put the money into that you're going to pay taxes, and then you pay on those taxes quarterly. So that way you're not at the end of the year with some big tax bill. Instead, you just spent $500 a quarter, $250 a quarter, $5,000 a quarter, whatever your taxes are going to be. And those are paid quarterly. So at the end of the year, you don't have a massive bill to pay. You just basically have that quarter to pay. Okay. So this is why it's done this way. Because if we don't, then again, the demand of cash in the business basically expands to meet the supply. And if all the cash is gone at the end of the year because you've used it, then you don't have the money to pay taxes. So there's also documentation differences between personal and business. So what I mean by that is you've got to track expenses, assets, purchases, income more in the business side. And this is why it makes sense to have a bookkeeper. It makes sense to have a bookkeeping agency. It makes sense to have Brex, which we talk about. So I talk about Brex and some of these guys that are great tools to help you manage expenses, that help make it easy to manage the accounting of the business, and also help you build business credit. Like I said, that's one of the reasons I talk about Brex so much, is that they help you do this and also build business credit at the same time. Now, here's the great news. You don't have to hire a full-time bookkeeper. There's a lot of stages in a business where you're in between the help that you need on the accounting side. Your business gets to a point where you don't have enough money to pay a bookkeeper, let alone accountant, let alone a controller. Then the business grows, and then you hire a bookkeeper, part-time, fractional, outside, inside, full-time. Eventually you get to an accountant. Eventually you get to a controller. Eventually you get to a chief financial officer or a CFO. As the business grows, the need for personnel that overlook your expenses, the actual accounting needs of the business grow. But in the very beginning stages, you need a bookkeeper, a bookkeeping agency. Now, the great news is that there are things called fractional bookkeepers that can help you here. A fractional bookkeeper is not somebody you have to hire full-time to keep on your staff. You're just using them fractionally, basically when you need them. So there's a lot of options out there that you can go to with fractional bookkeepers. We have changed accounting teams 10 times in the course of our business. And it's not because they didn't do a good job. It's because we outgrew them. Like the one we had at the beginning, wasn't meant to handle businesses that got as big as we did. So we had to leave them and we went to another firm and another firm and another firm. And the cost and expense continue to climb because of the demands that we actually needed from the accounting team. But in the beginning, start with a bookkeeping service. You don't have to hire a bookkeeper, but you should consider this because it's way cheaper than you think it may be. And it's better than your spouse or your partner, significant other, friend handling it for you. And let's be honest. A lot of business owners that get started, they're trying to handle their own bookkeeping or have somebody else, like a significant other, somebody that doesn't know what they're doing, handle it. And it creates all kinds of problems because, again, there's not enough money to pay taxes, amongst many other issues that can prevent you from getting financing. So look at these fractional bookkeeping services because they're way cheaper than you think it may be. As a matter of fact, it may even be cheaper than the solutions that you're actually using right now. So make sure you look at that as well. And Reba says, oh, I don't even, saludes. Reba, hello, thank you for coming in. George is coming in from La Cruz, New Mexico. Thanks for saying hello. Veronica from Forney is coming in here. From where are you at? From Forney, Texas. What's up? Veronica, thanks for coming in and saying hello. And Teresa Jones, hello. And Veronica, I already said hello to you already. So hi, thanks for coming in and saying hello. And again, if you don't mind, tell me where you're coming in from. I always like to give you a shout out, say hi. And if you're getting value, hit that like button along the way. So you should hire a tax preparation company to do your own taxes. Look, I understand that on the personal tax side, especially if you're a W-2 employee, it's not really hard to file your own personal taxes. You can use any number of different softwares to file your own personal taxes, especially if you're just a W-2 employee and you don't own a business. But then when you own businesses, you kind of need an accountant or somebody with accounting knowledge and experience to handle a lot of those for you. And the business side, you should always have somebody outside of your company handling it. I think that my tax preparer charges me $200 to file the taxes, unlike my entities that really don't do a lot. They're kind of shell corporations for any number of different things. So it's very cheap to have this done, and you should always hire a professional for business tax preparation, even though you don't necessarily need it on the personal side. The other reason you really need to do this is that they understand what throws up red flags and what doesn't if you're working with the right tax preparer. And let me give you two different examples. I have the same guy. His name is Ed Antonetti. This guy, Ed, has handled my taxes since I was in my 20s. He's handled it for 20-something years of my life. Always done a killer job. I'll send him my expenses, my P&L, and he'll say, hey, he won't even tell me. He'll make modifications and tell me if there are things that would throw up red flags in the IRS system. So as a result of the 20-something years that I've been with Ed, I've never been audited. Now, when I come and somebody told me once, you got to have a CPA that actually does your taxes. I'm like, well, maybe I should change from Ed to an actual CPA because Ed didn't have a CPA designation at the time. So I switched to a CPA and I went with them for 3 years. And all 3 years I was with them, I got audited every single year. And the reason was because what I submitted to them, they just sent to the IRS. They weren't checking in their system to make sure things weren't throwing up red flags and communicating with me. If they would have done that, I never would have got audited. So choosing the right tax preparer is a big deal because, again, they should be able to look at things, tell you if things are out of the norm of the IRS, would trigger red flags, and that's exactly what they help you fix. Now, here's another important note. This is why NAICS, or industry code, is so important. Because this is one of the things that the IRS uses industry codes for. Now, you've heard me talk about this before, and I'll pull it up for you real quick. An NAICS code is basically the type, it's a designator of the kind of industry that you have, right? So if I'm in, real estate, which I often like to use as an example, and if I come here and I'm a residential property manager, code 531311, well, then what happens is when I file taxes are filed based on this, my NAICS. When it goes into the IRS compares, they're not manually doing it, their computers compare my expenses to others in my industry. It's one of 100 reasons you've got to know your NAICS code and make sure you use it uniform when you apply for credit financing, open bank accounts, file taxes, etc. In this case, instead of diving into the other 99 of 100 reasons you should do it, in this case, one of the reasons is the IRS computer looks at your industry, looks at your expenses, looks at others in your industry, and it looks for outliers or issues, and that's what triggers red flags. So let's say I'm a trucker, right? I own a trucking operation, and all of a sudden I'm claiming $1 million a year in office expenses, which is really weird for a smaller trucking operation where most of your stuff is on the road. Well, what happens is that would throw up a red flag in the IRS system and say, wait a second, like this write-off is way out of line proportionally to what other people in the transportation industry are experiencing. That red flag then pushes it for a manual review, and that's how audits are triggered. I'm not an accountant. I'm not a lawyer. This isn't a legal or accounting advice. I'm just telling you that that's what NAICS are used for by the IRS, to compare your expenses to others in your industry, to look for things that are out of the norm that throw up red flags that trigger audits. So you got to make sure that you know what your industry code is. It's one of the important things about what I'm kind of teaching. But again, this is one of the things the IRS is using it for, to be able to figure out, are your expenses unreasonable for what you're claiming? Now, again, a lot of different ways you can come in and you can prepare taxes, whether you bring somebody in-house or don't. In the beginning, you don't need somebody in-house. You just simply need a fractional or an outside company. Eventually, you'll bring a bookkeeper in-house, and then you'll have accountants that are fractional. Eventually, you'll probably hire a full-time accountant team outside, and eventually, you'll probably bring an accountant internal. And that happens as you grow into 7-8-figure businesses. Now, let's talk about cash versus accrual. So there's two methods of accounting. Now, cash or accrual are the two, and cash basis includes income as revenue when it's collected. Let's look at this again. Cash accounting method basically includes income as revenue when it's actually collected. And expenses are deducted from revenue when they are actually paid. Now, with accrual accounting, you record income when you earn it and expenses when you incur them. So for example, using cash basis accounting, you don't necessarily count revenue as soon as items are sold. Okay, so a lot to be said here. You basically, with this and with this example, okay, for example, cash basis, you count it when you actually get the cash for it. So unless the buyer pays cash on the spot, you do not record revenue until the customer actually pays the invoice. No receivables are carried on the books. Now, accrual basis records revenue at the time of the sale. So receivable for invoice goes on the books. Unpaid expenses, uncollected income are higher at the end of the year. Taking those outstanding expenses is a deduction that can reduce tax liability. So let's look at this. So accrual basis records revenue at the time of the sale, not necessarily when it's collected. So that means that if I make a sale for $5,000 and somebody's paying me $1,000 a month, well, with this accrual, then we're looking at, okay, I made $5,000, but the company really didn't make $5,000 because it only collected one payment of that, which is $1,000. That's just an example of the difference between cash and accrual. Is that one, you're looking at the revenue when it's actually recorded. The other is when the money actually comes in. So which is better for you? I found that both are depending on the stage of the life of your business. You should talk to an accountant and get a breakdown of which one works better for you through the stages of your business. We have changed, right? I think we went from accrual to cash basis. So again, we've changed in the lifetime of our business. A lot of other businesses do. So I think both can work for you depending on the stage of your business. It's worth talking to an accountant to learn more. So when your business is profitable, for example, your outstanding receivables will likely be higher than outstanding expenses are payable. And if you're using the accrual method, well, you'll be recording more net income and paying more in taxes versus the cash method. The bottom line is, with accrual, you're showing revenue you haven't collected. So if you're setting aside money quarterly to pay taxes, you're going to be setting aside and paying way more than you should because you're paying on money you never even really collected. It was just sales you made, right? There's a difference between sales you make and what you collect. And again, perfect example. You sell something for $5,000. They pay you payments of $1,000 a month. You didn't make $5,000 if you only collected the first payment of $1,000. You only brought in $1,000. But if you're showing that you made $5,000 in sales and paying taxes on the $5,000 when you only made one, then the customer defaults and they don't pay the other payments. This is what happens where you end up basically paying more through the year than you should. Now, there's a lot of differences between cash and accrual, but it just goes to show you a little bit of the decision or a little bit that ties into the decision of which method to use. So decision of which method to use depends on your life, your business, where you are. Okay, some exceptions allow for changes to be made. Businesses with larger revenue or that carry inventory do not really have a choice at all, but must use the accrual method. And again, you know, we've changed throughout the life of our business, and you typically will too. So we're going to talk about depreciation as well, but I do want to give some shout outs to some new folks that are coming in and saying hello. So New Jersey, Tradeline, what's up? Mary Velez from Miami is in the house. And we've got, wait, I didn't show that. And then Melissa from Patterson, New Jersey. We've got Las Vegas is in the house with Nestor. Thanks for coming in, everybody. Thank you very much for saying hello. And again, here's an NAICS search that our team just threw up. So if you keep an eye on chat, a lot of the things I'm talking to you about, you'll be able to get the quick links and the shortcuts to be able to get all the cool stuff that we talk about during the stream. Okay, so depreciating decisions that need to be made as well, right? What do you depreciate? What don't you depreciate? What can be depreciated? There's all kinds of crazy things here, okay? You look at people that own really high-end cars or even airplanes, and it's kind of interesting to me because sometimes, haters will hate on these people for these decisions, but they don't understand the financial reasons people make these decisions. A lot of these things, like airplanes, for example, you can basically write off 100% of depreciation the year you buy it. I mean, there are people that go out, like Grant Cardone talks about this, as buying a plane in order to avoid paying massive amounts of taxes because he depreciates the entire asset. I'm not know if you like Grant or don't like Grant. I don't care. It doesn't make a difference. I'm just using a simple example of why people make these decisions. And I'm not telling you to go buy expensive planes and Rolls Royces. I'm just saying that there are things to be said, and it's why you need people that are smarter in your circle than I am, and even you are, on these type of things, because depreciation decisions really tie into what you buy. Okay, so typically depreciation on assets is written off over the course of 5 to 7 years. Now, the IRS allows a first year deduction of up to 100 grand for equipment and most furniture instead. So if you do not make a profit, you can't take it, but can carry it forward to a profitable year. So let's look at this for example. So let's say that I did the right things. I paid quarterly. Okay, now it comes in and I owe $100,000 to the IRS. Well, I can come in and say, hey, I need this major piece of equipment. Maybe it's whatever it may be. Maybe I need a boom truck, right? And now I can write off 100 grand my first year. So now instead of paying 100,000 in taxes, I now have $100,000 deduction, and it takes me from paying 100 grand to paying zero. Or maybe I buy the boom truck for my business and I'm not really showing any profit. Well, that 100,000 deduction can get pushed on to future years where I am showing a profit. So what I'm saying is that this helps you to buy expensive pieces of equipment, vehicles and such that you may need to be able to operate your business and be able to write that off, so it takes the place of you actually coming in and having to pay a bunch of money in taxes as well. So in the beginning, you might want a slower depreciation method, saving the deductions for later when there'll be more of an income and greater tax amounts that you're going to pay. A tax professional can help you kind of making those decisions. Now, how does all this affect your ability to get funding? Well, it has a lot to do with your ability to get funding. Okay, there's a lot of crossover here between what you're actually doing on the tax side and how it affects your ability to get money. So first of all, let's talk about entity type. The entity type you choose really has a lot to do with your taxes and your fundability as well. Okay, so what I mean by that is operating as a sole proprietorship really doesn't work, because at that point, you're not going to be fundable. You're basically paying the taxes as an individual for your business, and lenders and credit issuers, SBA, Entrepreneur Inc., SCORE, all these authorities say, look, sole proprietorships aren't even really businesses. They're people experimenting with ideas. So when you're going to launch a real business, for everybody's credibility's sake, you need to go with an S Corp. You need to go with the C Corp. You need to go with a different entity type, or an LLC if you do decide to be a sole proprietor, or you can choose an LLC as an overlay for other different entity types as well. Is there a difference between an S Corp and a C Corp? Well, not really, yeah, there is a big difference, I should say. And again, I'm not an accountant. This is an accounting advice. You should talk to an accountant. But and when businesses are smaller, an S Corp makes sense. But what happens is I'm corporation, but the profit and loss of the business carries over to my personal side. So let's say I just started Credit Suite today, or I started Credit Suite last year. Credit Suite makes $100,000 its first year. Hey, it's not a ton of revenue, so I'm okay with it carrying the profit or loss carrying over to my personal taxes. I don't have to pay, the business side of taxes. I only pay one set of taxes. I'm only doing the profit and loss of me personally, the business taking into account my income. It ain't going to work as the business gets bigger. As the business gets bigger, you're going to at some point almost have to shift from an S Corp to a C Corp, because you don't want to have a $10 million business where the profit and loss are carried over to you personally. So again, entity types can change through the life of your business as well. You might start as a sole prop, then you move to an LLC, then you move to a corporation. You might start as an S Corp, then you move to a C Corp. But again, this does have an impact on how you pay taxes. So it's the reasons you should talk to accountants when you're thinking about entity type. Now, the other thing is the SSN EIN. If you're a sole proprietor, you don't actually need an EIN number. A lot of people are still shocked by this. I'll be honest with you, when I first learned it, I was too, because I didn't even think you could have a business without having an EIN many years ago. But you do. You can have a business and it just be your SSN if you're a sole prop. But nobody takes you seriously then. Okay, the EIN is the number that is used to identify that your business exists. The same as the socials used by IRS to basically prove that you actually are a taxpayer here in the United States. But lenders and credit issuers, they want to see an EIN. If you don't have an EIN number, then you lose all kinds of credibility. You're just fighting an uphill battle with the IRS, with lenders, with credit issuers. And I don't have the stats here, But it's like astonishing the difference between audits. Actually, I think I do. Here's the statistic. If you are a sole proprietor, your chances of getting audited are 1 in 7. 1 in 7 that you will be audited. If you are a corporation, the chances of getting audited are 1 in 50. Okay, that's a big difference. So sole proprietor get audited considerably more, like 8 times more than those that aren't. So sole proprietor, chances of getting audited 1 in 7. Corporation, 1 in 50. So again, more reasons you want to be an EIN. You want to have an actual entity set up like LLC corporation. You want to actually have an EIN number. It goes a lot to fundability, goes a lot to help you with taxes and avoiding unnecessary audits, etc. as well. And guys, the audits, they don't mess around. Okay, I know a guy right now that's going through it. The guy is like, his comments out of it right now are things like, my life is ruined. My life is over. Because guys, they froze all of his assets. He can't even access his assets while they go through a lengthy review of what he's got going on. And I don't know if you've ever had any issues with the government before, but this is what goes down, whether you're at fault or not. I've had friends that did nothing wrong besides upset some jerk online, and the jerk online escalates things and creates like the attorney general to come in. And what they do is they cease and shut down the business temporarily, stop money from going through it while they conduct their investigation. Whether there was anything valid there or not, it happens all the time. So you always want to go on the side of caution here, because you don't understand. They come in and shut down your business. You lose the ability to make money while they're figuring it out. Now you have no revenue, and you got to go pay an accountant. You got to pay an attorney, all kinds of money to help you deal with the issue with no money coming in. So you don't want these things to happen, which is why, again, you really need to make sure that you do things the right way, even if it costs you a little bit of money to get tax professionals involved. Get the entity set up the right way, get an EIN, do everything you can to avoid these kind of audits. Okay, now what are lenders looking for in tax returns? Okay, I'll tell you a few things. They want more money coming in than going out of the business. And you know what lenders really want to see? Profit. It's that simple. Look, the difference between a business owner that loses $1,000 a year and one that earns $1,000 in profit is a big difference in my world of business lending. The one that shows the $1,000 in profit can get longer term, low interest rate loans. The one that shows the loss cannot. They can get money, but they're not going to get nearly as good at terms as the one that can. Remember what I talked about in the beginning. Longer term, lower interest rate means lower payment. The people that get longer terms and lower interest rates show a profit, even if it's a little profit. The ones that get shorter terms, higher interest rates, high payments, don't show profits. You got to file tax returns, and the sooner you can to show some kind of profit, even if it's a small one, you want to. Here's why. Because when we're small, we write everything off, we claim losses, we don't pay taxes. We all do it at the beginning of our businesses, right? But then eventually, like if you really are in a successful business, your business, you can't do it anymore. You can't legally hide the money per se. You just have to start claiming profits and paying taxes. The business has grown too much to a point where you can't avoid it. So business lenders know this, and they want to see the businesses that have grown enough to actually have to claim profits, and they can't just continue to claim the losses. So big difference in the world of whether or not you're actually showing profits versus actual losses. Michigan, Angelique is in the house. It's blurry. Mine is clear. Might be something on your end screen-wise, Melissa, but I'm not exactly sure what to do besides zooming in your screen in and zooming out. But if anybody else has issues, just so I know on blurriness, let me know. Mad Max, what's up from West Palm Beach, coming in. And Edward, Nashville, Tennessee is in the house. Thanks for everybody for coming in and saying hello. Okay, so want to make it look like you made as little money as possible on the tax returns. But again, there's all kinds of things you want to talk to bookkeepers and accountants for. Let me give you an idea. Right now, for example, there are credits out there for R&D. And there's a possibility that we may get a lot of money back from the IRS because we never claimed things before that we used for R&D. So if you didn't know that, you could maybe say, if you did know that, you could say 50, 100, $250,000 a year. That is direct money that comes in your pocket, real cash, if you knew about R&D tax credits, right? But if you don't know about these kind of things, you don't know. So again, another reason you want to have bookkeepers, accountants, these kind of people around you that can give you that kind of guidance. Okay, personal taxes can impact your business as well. Look, if you go to get SBA loans, traditional loans, your personal financials are going to come into it. You're going to have a P&L. You're going to have personal tax returns be needed. I'll give you an example. We were applying for an SBA credit line right now, and one of the very first things they asked for was a personal financial statement from me, right? Life insurance, my assets, my liabilities, my payments on everything. I got to claim it all on a P&L. So again, their personal financials are going to come into it. As a matter of fact, it's not a bad idea every 6 months just to update and keep a personal financial statement, because as the business becomes bigger and your life becomes more extravagant, you need one. Like anything you're going to buy is oftentimes going to require personal financials, including more complicated business loans like traditional loans. So make sure you have them. Now, the same thing with your personal tax returns. A lot of lenders are going to ask for those, especially if you start going for SBA loans. So again, can you get around this stuff? Usually not, until the business is strong enough to stand on its own. When the business makes so much money and its business credit profile is so extensive that it doesn't need you anymore to be able to be a guarantor, then you get around this stuff. But for a lot of us, for the first lifetime of our business, or for the first 10, 20 years, or until we get the business to 30, 50, $100 million, we're going to be a factor in it. So make sure you have a P&L or ready as well. You're going to need that for a lot of the more complicated loans. So as a recap, both personal business taxes affect your ability to get money, right? And not doing the things right will affect your fundability as well. Not filing taxes, showing losses on your tax returns, not having the right industry code on your tax returns. All these kind of things can create issues that make it harder for you to be able to get money. So next time we're going to be talking about how to build business credit very fast. And we're also going to talk about misconceptions with business credit as well. Don't forget, if we can ever help you get financing, all you have to do is give us a call. We don't charge you any money to be able to get funding. Like if you come to us and say, I want a loan, we're going to ask you questions. We're going to get you to a lender, and we don't charge you any money. As a matter of fact, it saves you money because we use our volume of loans to get you discounts. And our funding team can be here through the lifetime of your business, even helping you grow to the point where you get SBA loans. All you have to do is give us a free call, or give us a call at 877-600-2487. And we're going to do a free finance assessment for you. And this consists of three things. One, we're going to do a fundability check. We're going to tell you where your fundability is jacked up and what to fix to become more fundable. But the number one reason loans get denied isn't because of your income and credit. It's because of fundability. Overwhelmingly, more than half of all applications for funding that are denied are not denied because you don't qualify. It's denied because your fundability is not right. So we're going to do that, help you figure out what's wrong and what to fix. If you have business credit established, we'll get your business credit reports for you at no cost. We're the only place you'll get business credit reports with D&B Equifax Experian for free. And we review those with you, give you tips and tactics to build your business credit. And we do a funding qualification. We just tell you all the money you can get right now. That happens on a free finance consultation with us. You can give us a call at 877-600-2487 to be able to learn more. I should say free finance assessment. And if you got value from this, all I ever ask is hit the like button. What you do is help other entrepreneurs because you tell Facebook and LinkedIn and all these guys that, hey, this guy gave me valuable information. Show it to more people, and that helps me help more people, and we can help more people together. And don't forget to subscribe. You can go to creditsuite.com. It takes less than a minute. Subscribe on our channels. We have daily tips on Twitter, Instagram, Facebook. We have 1-minute video tips on Insta and on TikTok as well. And we've got over 1,000 videos on our YouTube channel and a podcast you can listen to on the fly with 500,000 downloads. Very popular. All of it is the top right of our page, creditsuite.com. So make sure you like and make sure you subscribe as well. Okay. And I want to say hi to Diane from New York City. If I can make it here, I can make it anywhere. I like it. I like it. I like it. So Diane, thanks for coming in. Thanks everybody for coming in. Thanks for coming in and saying hello. I always appreciate a chance to hang out with you, and I try to make great use of our time by teaching you things that will help you get money for your business. Look forward to seeing you tomorrow, where we will come in and we will talk about how you can build business credit quick, and we'll also talk about some of the misconceptions about business credit that cost people a bunch of time and money. We're going to fix all those for you as well. Angelique, thanks for saying thank you as well. Have a great day, everybody. Look forward to seeing you tomorrow. We talk about more cool ways to get money to start and grow